Hey there, awesome accounting student. Mark Franke here. This is a video for Accounting 101, Chapter 4. I'm going to talk about companies that sell a product called merchandising companies. These are the Walmarts and the Targets and the Costcos of the world. So, a couple of things to start off with. Number one, keeping track of inventory is going to be under two different systems, a periodic system and a perpetual system. We talked and used a periodic system with Accounting 100, where in effect when we buy merchandise is stuff we're going to resell, we buy merchandise, we just charge it to an expense account called purchases. And then at the end of the period, we go and count that inventory and make an adjustment to pull the expense for inventory we haven't sold out of that expense account, purchases, and put it on the balance sheet in an account called merchandise inventory. So again, in a periodic system, we buy it into an expense and then move it, what we didn't sell, to an asset. But under a perpetual system, which is what most companies use, we buy the merchandise into an asset account called merchandise inventory. And then as we sell it, we move it out of the balance sheet and onto the income statement into cost of goods sold. And that is what we'll be using in this class, Accounting 101, for the rest of the semester. So just a little bit different, but obviously in a perpetual system, there's more accounting involved because we have to keep track of everything that comes in and goes out. The key component from a financial reporting standpoint for a merchandising company in a perpetual inventory system is, well, either system is called cost of goods sold and gross profit. Cost of goods sold is the cost of what we bought, and the sales is what we sold it for. So the difference between what we sell it for and what we pay for it is called gross profit. Gross profit is really, really important for reporting purposes. So what I want to do is just show you some companies, and I have gone on to website to get information for these 6 companies: Costco, Walmart, McDonald's, Home Depot, Target, and Apple. So let's look at where that information is coming from. That will be on this website. You can get this information from lots of different websites. My favorite is called Yahoo Finance, which has every company, public company that you could imagine. And if you look up Apple computers, this is what you will find for Apple. Apple's stock is up almost $3 today. So you're going to get some summary information if you put in their ticker symbol. Ticker symbol is AAPL for Apple. And then under the tab that says Financials, we can look at their income statements for the past few years. And here is the Apple financial statements. So what I've done is taken the information for 2019, 2018, 2017, 2016, and I've dropped it into the spreadsheet to calculate the gross profit. So that gross profit for Apple is here. And you can see that Apple consistently is at right around 38%. So Apple's total sales for 2019 were $260 billion. These numbers are in millions. So 260 billion is total sales for Apple for 2019. Apple ends their year in the end of September, so we don't have 2020 numbers yet, but we will fairly soon. But you can see how consistent they are. Again, right around 38%, 38.5% for 17, 38.3% for 18, and 37.8% for 2019. The trend is that they're going down a little tiny bit from a percentage standpoint, but their overall gross profit is very, very healthy. So if you look at Costco, again, very consistent, 13% year after year after year after year. Walmart, very consistent, 25% year after year after year after year. Target, very consistent, 29%. And actually theirs is trending up a little bit. Target, it has a higher gross profit because their retail concept is more customer service oriented than Costco. At 13%, Costco being wholesale, you can get things cheaper at Costco. I don't think anybody would argue with that. But at Target, their gross profit, their prices are going to be a little higher for the same thing. Now, a lot of times Costco has larger bulk items that you buy. You can't get, smaller quantities of things. Their cereal boxes are bigger and their mayonnaise jars are bigger, but you're going to save money. But Walmart is in the middle. So you have Target making almost 30%, you have Costco making 13%, and Walmart is like 25% in the middle. The reason is Walmart has both concepts. Walmart has Sam's Club, which has gross profits similar to Costco, and then the Walmart stores, which has gross profits similar to Target. So when you blend those two concepts together under the Walmart name, you get a blended rate that's in the middle. Now, if you look at McDonald's, their gross profit percent is actually getting much better. They were at 46.5% in 17, 51.3% in 18, almost 53% in 19. But think about it this way, McDonald's is all about the volume. Yeah, they make almost 53% on selling burgers and French fries and drinks, but that doesn't really include all the advertising, all the other expenses that McDonald's has to deal with as being a retail restaurant chain. So if we look at Home Depot has pretty healthy gross profits, 34%, very consistent across the board for the last 3 years. And then let's see, the last one, I guess we've looked at all of these. So anyway, just it kind of gives you a feel for how gross profit is tracked and what types of companies this would be appropriate for, and these are certainly the ones that will. So let's talk about what happens when you buy merchandise. And we have this concept called free on board. Free on board, or FOB, is a legal term dealing with when title transfers. So if I have a shop in Los Angeles and I'm buying something from a company in Chicago, I have two choices here. I can buy it FOB shipping point, which means as soon as it leaves my vendor in Chicago, it becomes my goods. That means I have to pay for the freight and I have to pay for the insurance to move it from Chicago to my shop in Los Angeles. If I bought the merchandise FOB destination point, that means that when these do not become my goods until they get to my shop in LA. So in this instance, FOB destination point, the vendor has to pay to move it and to insure it from their shop in Chicago to my shop in Los Angeles. So naturally, there's going to be a price differential between buying something FOB shipping point and buying something FOB destination point. Typically, companies that buy things FOB destination point and companies that sell things FOB destination point are perishable goods. Meat, chicken, fish, vegetables, flowers. These are all perishable goods. And so I, as a buyer, I don't want those to become my property until I can look at them. So I want to look at the fish. I want to look at the chicken. I want to look at the meat. I want to look at the produce or the flowers or whatever it is, so I can reject it. If I don't like it, if it's not up to my standards or if it's spoiled or something, I'm just going to say, sorry, I don't accept it, and then the vendor will take it back. And companies that sell perishable goods, they know this. So in many cases, they're not going to send it to me in a common carrier. UPS is not delivering flowers or fish or meat. That's coming directly from the vendor. So the vendor's trucks or the vendor's own transportation company is going to move those goods from their shop to my shop so that it's in a controlled environment. If it needs to be kept frozen, it's going to be kept frozen. If it needs to be kept cold, it will be cold. And so they can control the environment in which the goods are shipped. But if we're talking about bicycles or Barbie dolls or all kinds of goods that are not perishable, then it's not really an issue, and FOB shipping point is the standard. But from payment term standpoint, payment terms are, and this should be something that you learned in your Accounting 100 class, where if I'm selling or buying, I'm going to be giving terms. I'm going to be buying or selling and giving payment terms, which means for net 30, I'm going to pay in 30 days, or my customer is going to pay in 30 days. Or I can offer a discount. 2/10, N30 means 2% discount in 10 days. Otherwise, it's due in 30 days. So that 2 means 2%. The /10 means how many days. And then the comma then designates, okay, but if you don't take a discount, you got to pay me in 30 days. Now, in this kind of an interest rate environment where interest rates are so low, there's very few companies that are going to give a 2% discount or any discount for early payments. So net 30 is probably 95% of the transactions because it's from customers who we do business with consistently. So we're willing to ship them the goods, let them look at the goods, receive them in, get them into accounts payable, and then send us a check so that I get paid in 30 days. And I'm fine with that. So that's the typical terms for transactions in today's environment. Now, the last thing is a balance sheet concept. It's called the current ratio or working capital. This is a measurement of liquidity. How well will the company be able to pay their bills? So the current ratio is current assets divided by current liabilities, and working capital is current assets minus current liabilities. So let's look at our 6 retailers. Here is Costco, Walmart, McDonald's, Home Depot, Target, and Apple, and their current ratio. So if current assets are more than current liabilities, and typically they should be or would be, then the current ratio is going to be 1 or greater. We can see Costco, Home Depot, Apple, and McDonald's all have positive working capital and positive or a current ratio over 1. For Target, Walmart, they have negative working capital, which means their current assets are less than their current liabilities, and so they owe more on a current basis then they have assets to pay. Now, with these companies, and McDonald's too for years, now their working capital is positive and their current ratio is over 1. But if you think about Walmart and Target, they're generating cash flow every single day. They really don't have a lot of receivables. You can't go into Walmart, go into Target and not either pay cash or pay with a credit card, which means that they get paid right away. That's how they can afford to have negative working capital and a current ratio below 1, because they're generating cash every single day. But this is, again, just a measurement that we can compare one company to the next, current ratio and working capital. Okay, those are the overall concepts for Chapter 4. I'm going to do another video into how this works transactionally, and I'm going to use serial problem 4 for that. And that'll be on the Canvas website. That's it for now. Thanks for listening. I'll see you soon. Bye-bye.